Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager for GDM. With today's webinar, the topic, as we already know, Advanced Find the Direction Techniques. In this webinar today, we will find out how to confirm trend's direction after we have received a signal on a technical chart, or basically said, to find what the current market direction is. Before we proceed with the webinar at hand, I would like to mention one more time, each and one of those webinars this month is connected one to each other. As we've already covered, the first webinar was Psychology of Trading. The second one was the first part of Advanced Trend Following Techniques. And of course, today's webinar, we will sum up a little bit what we've been talking so far about all of the trends we've seen with regards to direction and strength. We've been talking about uptrend, we've been talking about downtrend. The last time we've covered the sideways trend and how we should trade it, where we can generate signals to enter the market, and of course exits. All of the important points. Now the chart you see in front of you is daily chart Euro USD, as we usually start. Further, when we finish with the presentation, we will cover a little more different currency pairs with the same type of strategy, commodities, and I would like to mention for those that just joined in or are here for the first time, to please try to review the past webinars so you can connect the dots. It's extremely important that you've seen everything so far so you can actually anticipate what to do after. Another thing, as you already know, at the end of the month we will be holding a question and answering session. It's more like a seminar, free seminar of course. You can join in, ask questions from whatever topic you can consider appropriate, whether it's a question about the company, about your experience on the market, whether it's good or bad. It's no such thing as good or bad experience, it's only an experience. Now, the first thing we need to see here is that the template we've been using so far still exists. It's on the chart. We are going to use it. The relative strength index, the stochastic oscillator, Bollinger Bands with the appropriate settings, and the 200 exponential. Today, ladies and gentlemen, we will cover something, an indicator that will show you in two stages. The first stage will show you how you can use it accordingly to your current chart settings, your current chart setup. And of course, briefly in the second stage, we'll show you different key points, different possibilities, how you can use it as a single indicator to trade the market again. Of course, as we've already seen, as many as the indicators are on the chart, we need to have a confirmation on each and every one of it. Today's indicator, we are only going to use it as a signal indicator to show us market direction, whether it's uptrend, downtrend, sideways trend. This is the important important topic that we should not miss. I will introduce you to the moving average convergence divergence indicator, or the so-called MACD. Some of you traders out there might have already been using this on your charts, probably already benefited from the indicator itself. However, I will cover, as I mentioned, the two stages of the MACD. First of all, we're going to go ahead and plot it on the chart. You might see that it gets a little bit more crowded. We're going to use additional indicators in the next webinars. As you already know, we need to find out which particular strategy we need to use at the current market conditions. Whether it's up, downtrend, sideways range, as we mentioned, we really need to know which strategy we have to use at the very moment of the signal from the chart. So there it is. The MACD is, as we mentioned, moving average, convergence, divergence. But what we will see it on the MT4 is as abbreviation MACD over here. Now the settings are preset already from me on the chart. We will be using as fast, slow, and MACD simple moving average, the default settings of this indicator. Colors, of course, you can set them up anything you like for the main and the signal, and the levels if you want to set up as such. I don't really need that, basically because we have the so-called histogram that you will see here on your charts. There it is. It's those green bars. This is the MACD histogram. Okay, let's talk a little bit about what MACD is. Now, the MACD histogram measures the distance between MACD and its signal line. This is the 9-day exponential moving average of the MACD. Like the MACD and the MACD histogram is also an oscillator that fluctuates above and below the zero line. And the zero line, you can find it over here, which means this is the line in where the MACD histogram crosses over on those points over here. And this is a movement below the zero level. This is a movement above the zero level, and as such over here as well. The standard MACD is the 12-day exponential moving average, which is less than the 26-day exponential. Closing prices are used to form the moving average. So MACD, the 8-day moving average of the MACD, is plotted alongside to act as a signal line to identify turns in the indicator. Okay, the MACD histogram represents the difference between MACD and its 9-day moving average, the signal line. The histogram itself is positive when MACD is above its 9-day. All right. So it's negative when the MACD is below its 9-day moving average, of course. Now, as you can see, the moving average here, the 9-day moving average, is not plotted on this chart. It basically represents those peaks of the histogram, as you can see here. So in some charts, different charts, you might be able to see additional moving average crossing over the MACD, which basically gives you pretty much the same thing, with the only difference that the MACD here, the histogram, is with red and green bars representing changes in trends or signals, of course, prior to the technical traders that the trend is up to change. Now let's take a look at, as we mentioned, on how we're going to use the MACD. Now the first thing that comes to mind is what time frame. As I mentioned, everything is connected on those webinars. Each and every one of those indicators that we're using on daily chart, because of these settings that we're using, as we mentioned, relative strength 5 period, stochastic 533, Bollinger Bands 20 with exponential with the deviation of 2, and of course exponential moving average of 200, the most followed by traders. So the MACD is an important volatility indicator as well. As you can see in cases such as this one, the volatility is small here. Therefore, we don't have too much movement up here. It's quite obvious that it's a sideways range. Therefore, the price fluctuates between the ranges of 20 and 80 on the stochastic and 30 and 70 on the relative strength. As you can see, everything aligns in time. And this is the key point to remember here. The settings we're using, ladies and gentlemen, are aligned in time. What I'm going to do here is just scroll a little bit back in the past. Let's check the performance of what we're trying to mention here, the importance of this type of indicator. Now, every time the MACD crosses the zero level, regardless of the direction, in this case is to the upside. Let's align it and see where it goes. It's exactly where the price is changing direction. After the confirmation over here, the price is changing direction, reaching new highs. And in this case, it's very important to remember that this high here is higher than the previous high. In that case, we can expect a continuation in most cases. In this case here, however, what we can see is the 9-day MACD is crossing over the MACD signal, which gives us a clear direction to the downside. However, we need to see a crossover of the zero level to see a confirmation, which happens somewhere around here. And as you can see in trend, as we mentioned already, the relative strength and the stochastic are not playing any kind of role, because they're staying in overbought or oversold conditions for as long as the trend exists. Therefore, we're relying on our trend following techniques. Okay, we have to follow the proper trend. And another thing we should remember is the huge importance of the 200 exponential. You can see how many times it bounces off of it and changing, without changing any direction, it continues to the upside in this case, reversing the signal of the MACD to the upside one more time. However, let's consider a potential trade. If we consider a potential trade somewhere around between this point and this point, we would definitely be profitable with around 179 pips in this case for the euro, which is a pretty good trade for about 3 days. Now, what we need to remember here are the rules. Everything applies. When we have a direction on the market, we should definitely look at the indicators such as the 200 exponential moving average, for how long the relative strength stays in oversold conditions in this case, and this is the case in this area. So it stays in oversold conditions between this timeline and this one. When it's over, when it actually crosses over the 30, signaling that pretty much the trend is over, we have a confirmation with a bounce off of the 200, giving us an exit. And this is somewhere around the third or the fourth bar of the MACD. Later, as I mentioned, in the second stage of the MACD presentation explanation, I will mention the second type of the MACD usage, how you can use it to shift directions earlier, catch a better price. Right now, we need to learn about its behavior on the market, the way it gives you the signal. So basically, it always gives you the signal when it's crossing over the zero, and the maximum volume, the maximum peak, is from where the market starts reversing to the upside, or in this case, of course, or to the downside if it's above the zero level. Extremely important, one more time, stochastic and relative strength does not apply in directional trends. Only use it when trading the range, sideways movement. Only then it stays within the bounds. Only then you are using Bollinger Bands as well as a confirmation, as we mentioned in the previous webinars. This is actually the place where I'm going to make a slight deviation to tell you that due to the high importance of these webinars, due to the high interest of these advanced webinars, we're actually going to cover them one more time. We're going to repeat it next month as well, the month of December, as much as possible. We're going to cover. And so next year, in January, we will start from the basic trainings, from the very basic, and repeat it month after month with the advanced webinars as well. Another thing, due to the fact that we're going to have a separate webinar seminar for question and answering, after these sessions there will be no question and answering, but the questions you're asking will be answered straight away after I receive them into the chat below in the program. Please, if you have any questions, go ahead, ask anything that comes to mind. Regardless if it's about today's topic, we have enough time to cover those types of questions. If it's about the news, as we are well aware, in about 72 minutes to be precise, we're expecting U.S. retail sales and consumer sentiment index. Extremely important news with high volatility expectations, especially on commodities and currencies that are connected to USD. Okay, let's get back to the MACD. Extremely important thing to remember about the MACD is that when you see a flat type of MACD, like this one here, for example, or in some cases when the shift between the histogram going above the zero or below the zero, let's imagine we have it like this. This clearly shows sideways range. So this is where we're going to rely on what? On the stochastic and the relative strength index. As you can see, it stays within the bands. Oversold and overbought conditions continuously giving you beautiful signals to buy and sell. And if you align it in time, you will see that it comes around those points here. Well, that's all about that's all of the most important about the MACD. I'm not going to trouble you too much of who developed it, why it did it, what it measures. The only thing you need to know is what it does and what you need to follow. The green histogram, as I mentioned, is a bar chart. Included in the background of the MACD. It displays the difference between the MACD and the signal line, as we mentioned. Let's cover that one more time. Now, when the MACD is above the signal line, the bar is positive. When the MACD is below the line, the bar is negative. The actual height of the bar is the difference between the MACD and the signal line itself. What you see here in the chart, as we mentioned, this is our 9-day and this is our signal line. Now let's talk a little bit about that second part of how to use the MACD to generate additional signals. We can read the histogram, as I mentioned, to generate trade signals. Now, we first want to track the histogram as it moves away from the zero line. In other words, track it as its bars growing larger in size, in height. Okay. Once the histogram prints a smaller bar, we look to trade in the direction of the histogram's decline. Now let's see an example here. We can see that the bars are getting bigger and bigger in this case. And then they start getting smaller. Now the first bar, when the histogram starts getting smaller, the next bar we can enter a buy position. This is an early indication that the histogram will change to the upside, unless of course it makes a trout and then it makes another peak in this case, or in these cases here you can see multiple trouts and peaks. However, you are tracking additional indicators to support your theory, as I mentioned. Those moving averages that you have are a perfect guideline, especially on the daily chart. Now let's set up a timeline here to see where it goes. This is a secondary confirmation that you can buy somewhere around here. If you want another confirmation, you can take it from the breach of the 20 exponential over here, and you can track its development throughout the next movement of the histogram. So what we have is another turnaround here, smaller bar somewhere around here on this point, another timeline, okay. It goes exactly on the point where we should be booking our profits, somewhere around here on those two candlesticks, before we actually get a confirmation from the moving average here, another bounce off. You can see the price stays within the range, within the bounds of the Bollingers. So what we here define is a second peak. That's actually one of the presentations from yesterday when we were measuring with the Fibonacci retracement, that it actually becomes a range between 0 and 66. So we have a defined range from here to here where we can trade it according to indicator number 1, indicator number 2. And from here, what we can track is how big the MACD's histogram is. And you can compare it, of course, to the previous volatility. Let's move a little forward to see how it develops. What we can find here is after the range is over, somewhere around this point here, we have a new peak and then a new range. You can see how fast the MACD starts declining here. And you can compare it with the range between relative strength and stochastic. It stays within the range, so that's why it's still a range. However, in this case, it's only widening it between those 2 points here and this one here. So that's telling you need to have one here and one here. And this is our new existing range from where we can trade. Once that range is breached somewhere here, you can see the histogram expanding so rapidly, telling you this is an existing downtrend in this condition. If we compare it over here, everything confirms our theory. In this place, slight, small, very small sideways range here. On smaller chart, you will pretty much see that it's exactly a small sideways range, broken here from this candlestick, and again, continuing to the downside. This is a continuation over here, confirmed by the relative strength and the stochastic. It's staying in oversold condition for as long as the trend exists, and we can compare it to the larger histogram, larger bars that are coming out, and the 9-day moving average. barely touching the signal line of the MACD, which is somewhere around this area here, only telling us this is another sell point, which is confirmed over here, quickly going to overbought conditions on the stochastic. Relative strength is usually much slower than the stochastic. So if we already exited this position, we can enter another one somewhere around this candle, which is breaching the relative strength to the downside over here, the 30 level, and the 20 on the stochastic over here. A new low is posted, from where we can see the absolute peak of the MACD histogram, quickly crossing over the signal line, telling us the trend is up to shift, whether it's to sideways range or immediately to an uptrend. This is about to be confirmed. And how to confirm it, we already spoke about it. Use Fibonacci retracement on the first swing high. Check out how big it is to see whether it's becoming an uptrend or it's just going to be a new swing high, with a new swing high meaning sideways range, from where, and whether the 0 or the 66. From here we can see a continuation. From here we can see a shifting trend. So if you guys forget about how trends are shifting, let me remind you one more time. If we have an existing downtrend, it doesn't necessarily mean that it's going to shift to an uptrend immediately. It only means that the market is halting for some time within a range, as we mentioned, which you need to measure, that it's between 66 and 0. So you can trade that range, but not lose market opportunities. And yet again, if you see a break off from those 2 points, you can either see continuation of the existing trend or a shift in direction, meaning, in this case, we would have seen change of the downtrend into an uptrend. However, additional levels of the Fibonacci here are applied to see a continuation, and target points, which right now I'm not going to talk about them. This is another type of topic which is not extremely important. What you can see is on the weekly and the monthly chart where exactly we have strong support, where the price had difficulties in breaching to the downside. So you can just put a straight line and see where your potential targets probably lie. As you can see here, the range between 0 and 66 continues as long as the stochastic indicator stays between the bound. Also, the relative strength tells you the same. And here, the MACD is very small in bars, telling you it's definitely a sideways range. So this is how you can confirm with the MACD that it's a sideways range. Basically, it's measuring volatility. So the smaller the volatility, that means you can rely on stochastic, you can rely on relative strength, you can rely on Bollinger Bands and the moving averages. Of course, moving averages are also used to measure strength of current existing directional trend. As we mentioned, that's why we're using the MACD. So we do not apply hundreds of moving averages and start making the divergence and the convergence in between. Now, that's a good point for me to mention one more time, something that we've been teaching, in our previous webinars, which were for basic users, for basic traders. When we were talking about the usage of multiple moving averages, such as we already have a 20, we have 200, we're going to apply the 50 if we're talking about on a daily chart basis. So what you can measure here is the same thing that the MACD is measuring, the convergence and the divergence between the moving averages. The smaller it gets, the smaller the bars get. The same place aligned in time, over here. Moving average getting smaller here. That means it's about to diverge, and when it's converging, it's getting bigger and bigger. So, what we've learned so far, that using the MACD is a little more advanced method to measure volatility, one. Second, existing trend strength, and also continuation. When you see those peaks, that means something is either about to change, or you have to be cautious to take profit at the very first possible way. And if you see another expansion, you can see that the 9-day is first crossing over 0.1 here with the MACD signal. Another time crossing over here, confirming it's quite possible to see further downside. So those are the things that you need to see. How many times and where we have crossovers of the signal and the MACD. Especially when we see such a thing around the level of 0 here, that's a key point. That's a key point in triggering a new trend or shifting an old one. It's somewhere around here. You can see from where it actually started. This is the breakout point of our 66% retracement on the Fibo. Right? Okay, we have covered everything about the MACD. The first thing, how to confirm a trend, how to follow it. This is how we can use it along with other indicators that we're using. Along with that, it can, alone as an indicator, trigger signals for entries and exits. That is why it's so useful indicator. A lot of traders are using it, but not everybody is actually understanding the meaning of it. What we will take a look at, ladies and gentlemen, right now is we will cover some other different currency pairs. If you have any suggestions, be my guest. Not a problem to present the same template over a new currency pair, the one that we usually do. By request, I've saved them down here: Euro USD, GBP USD, USD JPY, and gold so far. If you have any propositions, go ahead, do it. We're going to save this template. The last one was the sideways range, as we've been using. You can see it here. Right now, along with the MACD, we will create a new template. We will name it Direction Recognition. So we can, of course, apply it to every different currency pair that we want. There you go, additional MACD with the preset settings here. Everything that you need for your fast execution. Let's take a look at the pound versus the USD to see how it goes here. After a sideways range, the trend shifts. As a trained eye, I can see that it shifts somewhere around the crossover of these. This is another confirmation, but let's take a look at, measure that, and see exactly where it goes. According to Fibonacci, we have a break of the 66 of this sideways range here. That's actually a good point here to, yeah, thank you very much for, yeah, thanks a lot for reminding me that. Now, one of our traders just prompts me to remind you guys one more time that when we see a lower high, like this one, lower than the previous high, so this is our high, very important, this is our low high. That's how we actually find out how to draw the Fibonacci. So it should be until this point here. Okay, now this breakout is a fake breakout. Of course, it's a long time from here to here, and it's only a slight peak with sideways range and goes back within the Fibonacci. So basically, when we see something like that, we are extending our Fibonacci to our new established high. So we had a sideways range here on point 1. After a breakout of our point 0, it's a continuation, point 2. With the break of that point, somewhere here, I will show you, this is, I believe, the 14 or the 33, we'll head there, is our shift of direction. Let's extend it. Some people were asking how to use that Fibonacci. When you have it at some point, up lower, at the beginning of the trend, what you need to do is just extend it. You don't move it, you just extend it here to the highest point. And our shift in trend is exactly the 33, the breakout. However, our confirmation for a downside comes around the 66, the very important place from where we can sell. We do not sell when we have a breakthrough from the 33. Why? That's the thing that our trader reminded me, is because of the volatility of different currency pairs or commodities. When an instrument is extremely volatile, it can range between 0 and 66. If the instrument is less volatile and less liquid, that means it's going to range between 0 and 33. That's why we're using those levels, not only to find out our trigger points, but our shift of direction. So we have a sideways, we need to find when it's going to end. And this is where it ended. Confirmation from the relative strength, confirmation from our stochastic indicator. However, in these cases, our peaks on the MACD are not so certain. They're getting smaller and bigger with troughs and peaks. Why is that? Because in every time we make a new low, we have a retracement which is more than 66% from the previous one. This is because the market gets in a downtrend, shifts into sideways trend, and then a continuation to the downside. This is the key point. That's why the GBP is so important, because extremely volatile instrument. And we need to take it as an example from where we need to have our exceptions, and that I will show you. We had a new high here confirming our downtrend. Okay, we are going to measure it. There you go. It's precisely 66%. It even closes below it. Those two huge candlesticks. That's why we have so much fake signals from relative strength, from stochastic, and from the MACD. So here, in a short period of time, we have downtrend plus sideways and another downtrend. And this is between in 1 month. And in distance, 540 pips, 360 pips, and 450 pips for 1 month. Approximately 1,600, 700 pips, roughly calculation. This, as you already know, in only one lot is about $100,000 profit. If you manage to properly set up your chart, properly get those signals. So here's the deal. Every time you have a new low, extend your Fibonacci from your existing point A over here to your new low. This is where you're going to get your confirmation. Let me zoom it in for you a little bit. Probably it's going to be difficult for you to see here. From the new low here, the next day the price is retracing up to the 14 level. Exactly, the shadow closes at the 14 level. This is another intraday opportunity to catch new direction. This is a retreat by 52 pips, or just hold on the existing one. However, as we mentioned, the volatility of this indicator posts a new low with my very much favorite formation here. If anyone can guess it, that was from our basic trainings here. It's without this one. Disregard it. That's a morning star formation. On the bottom of a downtrend, shifts direction to the upside retracement over here. With the new established low, we're moving it down to the lowest point, which is this one. And we're posting a new high over here. How to find out whether it's a sideways range? Well, the next high is lower than the previous. So we have our high, and we have our low high, which we're setting up our boundaries between 66, 0, and another important level 33, from where you're getting your triggers to the downside and to the upside. You can see the price posts a new low here and then retreats. That's why when you're looking at a daily chart, do not remove your Fibonacci retracement. It always generates you the signals. This level still holds at 66, not much of a change. The retracement is 33. That's telling you that it's within the necessary retracement level for a continuation of a trend. Bounce off from the moving average, clear picture here, another formation over here, a new low is posted. Then a retreat to the same level and continuation. So this was a quick analysis. However, in this range, as you can see, you can keep trading those Fibonacci levels and still rely as a sideways range on overbought and oversold conditions of the RSI and the stochastic. Also on the height of the MACD histogram. Not much more to say about that. Let's take a look at another currency pair. Instead of the JPY today, we had a proposition to use the New Zealand dollar versus the USD. So we're going to take it straight from up here, and we're going to apply our template. Here we go. Shifting at the end to check out the current market conditions. Well, let's make a quick analysis to see what we have over here. Everyone can suggest an uptrend, post a new high, then retreats. If we measure it, that's going to be 33%. It's not difficult for a trainer to see that. A new high is posted, and then the next high is lower than the high. So that's telling us that it's shifting to the sidelines. Let's clear it up. Let's measure it with the Fibonacci one more time. We have our retracement more than 63% right now. Shift the chart a little bit so we can draw. What we can expect here is once we have triggered our up position, we're still in a running profit. We have a confirmation that the price is holding above the moving average with a possible additional direction and additional, well, what do you know? This level applies like a butter. That's why I've been using the 14 level as middle level between 33 and the 0, because the price usually stops by saying stops. That means taking support or resistance somewhere around that 14 level. What we can expect is to take profit somewhere around the 14 level and run for the big profit for the 0. And if it's breached, we can expect further upside movement. If we want to see downside trend, we have to have a breach of 33, which will be well below those existing support levels here. Quick analysis. We have active range, new highs posted on relative strength and the stochastic. We have new high posted here, which means volatility is shifting to the downside from the higher peak, which is here. If we apply a trend line, we will be able to see for how long this movement will continue. And it's clearly right now in a sideways range. So if some of you are afraid to trade sideways, if it's difficult for you to catch a good price, find a good entry, please let's schedule a one-on-one session so I can clarify that. It's different with different currency pairs. Some of them are more volatile than others, so levels are different. But in general, 66 and 0 apply as a continuation or a reversal of a trend. And during that time, you can rely on the stochastic and the relative strength plus the MACD to tell you whether it's a sideways range. And as you can see, the lower the volatility, the lower the bars of the MACD. As soon as it starts changing to the upside, it's triggering a reversal from here. And you have to say that the convergence between the signal and the 9-day moving average is aligned perfectly in time, giving you a breach of the relative strength to the upside from oversold conditions and the stochastic from oversold above the 20, a clear first signal that the trend is going to go to the upside. And if you're a little more conservative as a trader, you can use the Bollinger Bands and the moving average to confirm that it's breaking out of this short-term sideways range. As I mentioned, once you train your eyes to see those things, you pretty much don't need to use those kinds of indicators such as Fibonacci retracement or equidistant channel or trend lines or any kind of vertical or horizontal lines. It's you're pretty much going to see that it's going in a one timeline. Here and here, the peak, the lower high of the MACD with the higher high here, telling us something is wrong, the trend is about to shift to a sideways range, and you have a confirmation with this dodgy in oversold conditions changing direction of the MACD histogram. There is another very curious currency pair that you want to check out. Unfortunately, the Turkish lira right now is not ready to be traded, So I believe that you're a non-existing trader of ours, someone that joined us from the website. That's quite all right. If you would like us to make you a list of the existing instruments that you can trade, that would not be a problem. And someone is raising a hand here. I'm going to give you an opportunity to speak. Everyone will be able to hear you. Go ahead. We hear you now. Mr. Kotomutu? If you can speak over the microphone, you're free to do it. You've been raising hand for the past 50 minutes now. Well, I guess our trader is experiencing some trouble with the microphone. So, Mr. Kotomutu, please use the chat if there is a question that you want to ask us, or if there is a problem with your microphone, just let us know when it's been ready. It's been fixed, so we can just let you through to ask your questions or make your suggestions live on this webinar. For now, we're going to continue with, let's see gold, for example, as a active traded commodity. We're going to use the same template over here to see what's going to tell us. And this is actually a perfect example here, ladies and gentlemen, of how slow the volatility goes with the MACD and this very long sideways range on gold. So how about that? The price is moving between the range of the relative strength and the stochastic, telling us we're going to use indicator 1 and indicator 2 as active trading tools, plus indicator 3 as an addition as the confirmation Bollinger Bands, and number 4, MACD only for confirmation. Okay, only for confirmation. Only for confirmation to tell us whether it's a sideways. That means we need to have small bars, smaller than the previous ones. That's pretty logical, isn't it? As you can see, higher bars here, and it's still a sideways range, a short one. Higher bars here, so we have to expect below the zero and above the zero, smaller bars than the previous. This is where we're going to say it's a sideways range, the volatility is slow. In that case, we can apply relative strength stochastic Bollinger Bands. Now, if we have sideways range, such as this one here, okay, once the price stays within oversold conditions of the relative strength, we have a crossover of MACD 9-day plus the signal moving average. We can say that we have an existing direction, whether it's so sharp that at some point shifts in another sideways range before it actually shifts to the upside with the same force, or we can pretty much trade this direction for as long as those two indicators stay in oversold conditions. You can see them apply in one timeline. And this is exactly where you will find that the peak of the bar is your exit. No matter if it's this bullish strong candlestick here. That doesn't matter if you lose a little bit of your running profit. What matters is the confirmation for your exit. Now, if that doesn't come, you will be losing more than a portion of your running profit. Okay? The new existing sideways range is giving you opportunities to enter. You can see the volatility slowing down, telling you it's a sideways range for sure. What we can do as well, in addition to all of that, is just take the Fibonacci and measure where you're going to trade it. As you can see, between 66 and 0, in some cases. We have more than 66% retracement, especially on gold. You can see that it's just one of the most volatile units on the market. More than $50 to $100 per day range, it's possible for this commodity. That's why I prefer it, because when I'm on the right side of the market, my profits are way bigger than my losses. And that's the most important part, isn't it? Well, if we have to retrace that one more time, just to see when we believe that the trend is over, we have to see what that retracement is. It's within the 33, suggesting a possible continuation, which we have it in this strong bearish candlestick, from where we're extending our 0 point to find whether it's going to shift into a sideways trend, and of course whether it's going to go up or down. Well, this is pretty much it about the additional usage of MACD and other indicators, the alignment between them, how they correspond along. Now, what we will do the next time, we will be talking a little bit about Elliott waves, okay? But the webinar after, so that's pretty much next Friday, we will be talking about an indicator that is extremely important for mid to long-term traders. That is why when I mentioned that everything is connected, all of those indicators will be used in correspondence to whether the trend is up, down, or sideways. But when to use that particular strategy, we will find out next Friday. Before that, we will take a break from this particular, how to say, sequel of these webinars with Elliott waves. It's an important webinar as well. We need to know how to stay on top of a situation when we consider daily to 1 hour chart. Okay, we have a question here. Thank you very much for the question. Our trader here would like to be advised of the periods for the relative strength and the stochastic. Okay, the one place, dear trader, you can find that is over here. Now the stochastic in brackets, you can see 533, and the relative strength also in brackets, the period of 5. Now let's take a look at how you can moderate that, how you can modify it. We can find it over here. When you are selecting the relative strength, you have a period, you're entering 5. Now, for your information, dear trader, I would like to add additional note to that. First, when we've been training on simple trading strategies for basic traders, okay, for not so experienced, let's put it that way, we've been using different setup for those indicators. We've been using 14. We've been using 14 periods for the relative strength, 14 period for moving average, with the Bollinger Bands deviation of 3. And of course, we've been using Williams percentage range. So that's another, another topic that we might be able to discuss it. Also, let's take a look at the stochastic. It's also on parameters. K period and D period are 5 and 3 with regards, and the slowing is also 3. So basically, this is where you can find that information, how to amend it. Well, that's pretty much it. If additional questions appear in the future, please let me know via email or just phone us at the office, whatever question that might pop up. Right now, we're just a minute after the hour. We're expecting the news to come out from US in about 30 minutes. There's a lot of trading to be done. So this will put an end to today's webinar. If there is anything that you have missed from today's webinar or any other webinars, you know how to find the recordings. Everything is recorded and we're uploading it in our YouTube channel. Now if you can't find it, phone us at the office, just go to the support chat or strictly to my email address and you will find out what you need, whether it's the link directly to a current webinar or to all webinars. Thanks a lot for joining. Don't forget to sign up for the next webinar. We will be taking an in-depth to Elliott waves. Thanks a lot. Bye-bye.